Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Good morning all. Welcome to Cut to the Chase. This is Daniel Lam here. Finally, we have a US inflation print that is below expectations. That must be a welcoming print to the majority of the investment community. I will start off with the actual figures, and then I will discuss the implications on the Fed, and finally, what it means for asset classes going forward. So the first part, the figures. Headline CPI slowed to 8.5% year on year, which is below expectations at 8.7% and down from 9.1% in June. In terms of month on month, this figure is the lowest since the first pandemic wave. So as we know, the source of this inflation is mostly on the supply side. The two key elements there are energy and food. Now, energy was down 7.6% month on month in July. Food prices rose slightly, but we do expect that both food and energy to ease further in the coming months because of supply chain normalization. Now the second part. All these sounds very upbeat, but are we out of the woods yet? Will the Fed back off from their hawkish stance? That's a bit too early to say, because the Fed really wants to see a more sustainable deceleration. The two sources of inflation that the Fed needs to see deceleration are shelter cost, which is 1/3 of the CPI basket, and labor cost. So there's still an 80% probability that the Fed is likely to hike 75 bips in September. On to the third part. How should you be fine-tuning your investment portfolio? Should you be going bulled up in your asset allocation here? Now, of course, this news is really the best news we've seen on the inflation front this year. But we would suggest investors to remain balanced. If you look at the price action, both the long end and the short end in US yields were down initially, but went back straight up, while the S&P 500 broke key resistance at 4,200. Therefore, investors should be maintaining a barbell or balanced approach. So on the one hand, you want to maintain your exposure to equities because growth remains healthy. But at the same time, you must be alert of the possibility that the Fed may go over hiking in their rate cycle and causing demand side to slow down a little bit too much in the future. So you really want to look out for those opportunities where, for example, the US 10-year yield goes to the 3% to the 3.25% area, and you can be rotating some of your equities exposure into fixed income because the yields remain near a 10-year high. That's all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.